Welcome everyone to another episode of Wealth Talk. We've entered results season, so as mentioned last week, we'll focus on results. So far, around 263 companies have declared their results. Out of those, 172 companies have increased their profits, while about 91 have seen a decrease in profits. That translates to 65.40% of companies showing profit growth and 34.60% seeing a fall. But what's interesting is that the companies increasing their profits are doing so by around 6.07%. Similarly, companies whose profits are decreasing are only seeing a drop of about 3.02%. So companies with increasing profits are showing improved efficiency and demonstrating capacity by growing profits. This is something we need to understand. Besides that, as we mentioned, whenever we shortlist companies, we always say this. Any company with a market cap less than 1,000 crores is simply not suitable for retail investors as an investment. So if we look at how many companies we've shortlisted and approved, around 49 companies met our filters, those with a market cap over 1,000 crores. Among them, if we look at their results, 42 actually increased profits. Their average profit growth is about 5.43% overall. Only 7 companies saw decreased profits, with their net profits decreasing by 1.34%. Out of these 49, applying our quality filter, there are almost 37 such companies that we consider as good bets for investment. The reason is, as I always say, a good bet means having at least 30% scope to grow and showing good results in terms of growth. So first and foremost, let's discuss Reliance Industries. So one of the biggest market cap companies in India is our Reliance Industries. If you look at their latest quarterly results, you'll see that the net profit has also increased by a huge margin. Of course, if you dig a little deeper, what you need to understand is that this is because they diversified their stake in Asian Paints. Recently, if we look at how their current business is doing, again the results are too big to fail, but you might notice a bit of contraction. In their core business, oil to chemicals, oil manufacturing, or even in their retail business, the results at least indicate there's a bit of a slowdown. On top of that, maybe investors too, ever since the results were declared in the last few days, have seen a bit of a correction. Of course, along with the broader market, this stock also corrected by about 2 to 3%. At least we can look at it in terms of price. So Prasad Garu, how can we treat this huge company? Are there any red flags, or is it still a worthy company to hold?
It's definitely a company to hold, no doubt about it. So, even though Reliance Industries is a big company and its net sales increased sequentially from 9,64,693 to 9,76,541 this quarter, when it comes to profit, after a big one-time gain from their investment stake sale, as mentioned previously, if you remove this exceptional gain, you see the company's core profit after tax PAT this quarter is 94,020, which is still a substantial figure. Interest cost for the quarter is 25,387, and over the past several quarters, interest has ranged from around 22,588 to the 25,387 level, showing only a mild increase despite the company's massive size and operations. This stability signals financial discipline. As for debt and credit trust, the data indicates strong confidence from banks and institutions, with the company able to raise funds at competitive rates, a key positive for Reliance. Currently, the market price is 1,397.3, with a fair value estimation of 2,185.19, reflecting a potential upside or gap of approximately 56.39% from fair value to current market price. This suggests the share may be undervalued at current levels. Recently, Reliance has corrected from a recent high of around 1,570 to the current 1,370 to 1,375 region, which is a drop of nearly 200. This correction, set against the long-term fundamentals and future growth visibility, provides an opportunity, not a red flag. So, this is a company that still warrants a place in the portfolio. Following prudent allocation principles, exposure to any single industry should not exceed 20% of the portfolio's value, but Reliance remains a high-quality stock for inclusion.
Next, we have HDFC Bank. Of course, private banks have been in focus last week. If we look at just the latest quarter, profits have come down a bit. Most importantly, the commentary was all about the latest provisioning, meaning making provisions in advance before something is declared as an NPA, which has increased fivefold up to around 14,000 crores, as HDFC Bank has at least declared. Maybe this is to say that it's not such a great credit situation and that's why they declared it. The commentary about this is also something we can find on the internet. You can check it out. So in the latest quarter, HDFC Bank saw a bit of a correction, but in the trailing 12 months, since it's such a large company and still a bank showing stability, we'll have to see how much of these become NPAs, or at least how many might turn into NPAs. How much attention should we pay to that? And is there any underlying trend because of it? I mean, even private banks have shown somewhat muted performance this quarter, right?
We've already discussed banks in general and highlighted how income comes from various investments. HDFC Bank is always valued higher than other banks thanks to its dynamic yet conservative approach and the visionary leadership under previous chairpersons. However, since the management change, the bank's NPA provisions have jumped 5 times. While total balance sheet impact isn't massive, this shows HDFC Bank, like its peers, is now more exposed to NPAs. The main issue is heavy reliance on retail loans, often given with minimal security, packing and repacking these loans, selling, then repurchasing them, just to manage the loan-to-deposit ratio. Deposits aren't growing fast enough, so, due to Reserve Bank guidelines, they sell loans to raise money for fresh lending. As a result, less deposit growth means less support for new loans. Add to that, rising interest rates have made it tougher for HDFC to attract deposits, especially when other banks offer more competitive rates. Also, for contract-based businesses, income from bank guarantees is now under threat from insurance and other non-bank competitors. As big contractors turn elsewhere, a share of traditional income is lost. With loan efficiency down and delinquencies on the rise, all these headwinds mean HDFC Bank's premium position is slipping. Margins are compressing, provisioning has become a routine, and its once unique standing is gone. So, while the bank isn't in trouble or headed for losses, there's nothing positive drawing investor interest right now. At present, HDFC Bank's stock is more of a touch-me-not. Unless upcoming results show a real turnaround, it's not suitable for buying under current circumstances.
Right. Next, let's look at Ultratech Cement. Of course, just before the monsoon quarter, it's normal for results to dip a bit in this seasonal business. It's not just our observation. Everyone knows this. It's not even a secret. It's just a fact. So in the upcoming monsoon season, there might be a bit of contraction. It's unavoidable. For this kind of seasonal business, on one hand, the government's infrastructure spending, which slowed down last year due to elections, is definitely being pushed ahead. In the coming quarter and even in the next year, they will continue to push on with this. Looking at all these factors, people ask how to form an overall calculated opinion.
What we need to remember about these big companies is that once a company becomes very large, unlike smaller companies, they don't usually focus solely on net profit or try to declare higher profits just to impress investors. Big companies typically don't do that because they know their brand value and they also have a clear understanding of their worth in the market. So what they do is they calmly focus on improving operational efficiency. If we look at these companies, let's say we check their profits. For example, looking at the last few quarters, in September 2023-09, Ultratech Cement's profit after tax (PAT) was 5,703 crore and 28 lakh. Now, in the most recent quarter, June 2025, profit after tax has increased to 6,884 crore and 32 lakh. At one point, it even reached 7,008 crore and 96 lakh. So now it's at 6,884 crore. Should we think that's less? Or compared to 5,700 crore, should we see it as growth? For large companies, profits don't usually grow rapidly. Even a small profit increase, if it grows faster than sales, should be considered a good sign. Percentage sales growth from 67,933 crore to 77,752 crore is about 14.5% growth. Now, profit increased from 5,703 crore to 6,884 crore, an increase of 20.7%. Since profit grew more than sales, this is a good long-term trend. To support this further, earnings before interest, depreciation, taxes, and amortization has gone from 11,847 crore to 14,692 crore, the highest level ever for the company. This indicates a significantly stronger cash position. Net profit has slightly decreased from its recent peak, mainly because of variations in tax, but operational results remain outstanding. That's why we're talking about this company. Based on all this, what fair value did we arrive at? 17,204 crore. Since there's a 40% scope here, if it is suitable for buying, you should buy it. And if you already have it, you should definitely keep it locked away in your portfolio. Only if the price reaches 17,000 crore, then you can consider selling. Otherwise, you don't need to worry about Ultratech Cement.
Let's also analyze Nestle's results. Sir, looking at Nestle's latest quarterly results, even though there's no global inflation, Nestle is definitely facing raw material pressure. As for profits, in the latest quarter, actually for almost the last 6 or 7 quarters, it's been a zigzag, sometimes going up, sometimes coming down, then up again, then down again, and so on. If you look at it independently, or if you look at the trailing numbers, sales are continuously increasing, but there's a contraction in margins. So what this means is there's a bit of pressure, maybe some price pressures at the global level, or raw material pressure, or even consumption pressure. That is, even consumption seems to be under a bit more pressure. We can decode these results from Nestlé to mean just that. After seeing this, at this time, whatever the correct price is, if Nestlé is at the right price now, since it's a very big company and its growth is stable, would you say this is the right company to invest at least a small amount in?
In September 2022, Nestlé India's total sales were 18,671 crore. Now, in the latest quarter, June 2025, sales have increased to 20,358 crore, an increase of about 9% over nearly 3 years, noticeably below a full 10% rise. If sales increased like that, did profit also go up by the same amount? Net profit in September 2022 was 2,971 crore. It has now only gone up to 3,107 crore, an increase of just about 4.6% over the period, so substantially less than sales growth. When we say no growth, it means you shouldn't buy it, no matter how cheap it gets. If you think, I'll buy it because the PE has dropped a lot, you'll only be inviting trouble. Otherwise, you shouldn't even touch this company by mistake. Even after its recent drop, if you want to sell it right now at this rate, you can wait. Why? Because the fair price is up to 2,612, while the current price is about 2,281. So, there's no harm waiting until the price approaches 2,600 to consider selling rather than booking a loss now. But as for investing even a single new rupee in this company, based on the evidence, shrinking margins, muted profit growth, and operational cost pressures, it's not a good idea at present.
Alright, let's now focus on Bajaj Finance. Even after seeing such stability, such growth, and this kind of increase in net interest income in Bajaj Finance's results, why did the price still fall? Of course, just like HDFC Bank, they have also slightly increased their loan provisioning for NPAs. Why does the market react like this even with such big companies?
This company is suitable for buying in every respect, so all initial results are good. You can see the net profit margin, NPM, changed to 24.57% this quarter, a very minor 1.01% decrease from the previous period. If you look at net profit, it's 17,633 crore and 79 lakh, trailing 12 months profit after tax. That's a profit never before seen in the company's history. Starting from 13,784 crore September 2023, it has increased by almost 4,000 crore. That's a tremendous increase. Sales and profit are up. Margins are maintained. No need to worry. The only reason is that, as of today, better companies are ready to be bought, so official approval hasn't happened yet. But if your focus is on this, and you're wondering whether to buy only this or not, you can buy it without hesitation. Why did the company's share price suddenly fall? It fell due to investor perception because of a lack of awareness and not based on core financials. For about 12 days or a week, investors just trade that company's shares. For people like you and me who are in it for the long term, this doesn't bring profit. Fair value is up to 1,218.78, so right now there's a 35% gap between market price and fair value, a rare opportunity in a 5 lakh crore plus company. So, without a second thought, Bajaj Finance should definitely be considered a company worth buying.
Alright then, with that, let's conclude for this week. In the coming days, more companies will be declaring their results. Next week as well, we'll pick 5 or 6 companies for a special focus and try to analyze them in depth just like this. So make sure to tune in. See you again next week.